Are you prepared to pay twice as much for fuel this summer? Experts are warning of a substantial price surge as fuel inventories continue to shrink. OPEC Plus has reduced oil production, and short sellers are betting on falling prices. The Energy Information Association predicts a nearly $10 increase in the price of a barrel of oil, which will significantly impact gasoline prices nationwide. Some states already have drivers paying over $4.90 per gallon. However, the shock could be even greater as seasonal demand rises, as reported by Bloomberg. Further adding to concerns, recent research indicates that U.S. gas pipelines are at risk of experiencing outages. Regulators are urging officials to take preventive measures before a nationwide disruption occurs. This is the focus of today's video. But before we proceed, we kindly request your support by giving us a thumbs up and subscribing to our channel. North American analysts report that the average price of a gallon of regular gas has increased by 21 cents in just 1 month. In several states, prices are approaching the $5 mark. For example, California drivers are currently paying $4.915 per gallon, while gas prices in Hawaii have reached $4.78. In Arizona and Washington, prices at the pump exceed $4.50. Patrick DeHaan, the head of petroleum analysis at Gas Buddy, attributes the recent rise in gasoline prices to refinery issues and low supply. DeHaan anticipates that the national average will climb even higher, particularly if unexpected refinery outages occur or major hurricanes and economic developments arise. Moreover, DeHaan expects gas prices to rise significantly beyond initial forecasts due to the debt ceiling passing through Congress, which is expected to sustain fuel demand throughout the summer. Additionally, after OPEC Plus announced cuts in crude oil production for the remainder of the year, the U.S. Energy Information Administration revised its Brent crude oil price projection for the second time this year. The agency predicts that the cost of a barrel of Brent crude will reach $1.85 in the upcoming months, nearly $10 above the current prices. The impact on U.S. gasoline prices is expected to be significant, as crude oil surpasses the $1.80 per barrel mark, according to Andrew Gross, AKAA spokesperson. The prospect of Brent crude soaring above $100 per barrel, as suggested by industry insiders, adds to the unsettling outlook. James Davis, the director of short-term Global Oil Service and head of upstream oil at FGE, emphasized the likelihood of Brent reaching $100 per barrel this year due to voluntary cuts planned by OPEC Plus members. Last week, oil prices began climbing based on predictions of a tight gasoline market and a warning from the Saudi energy minister about potential further OPEC Plus output reductions. Concerns about a supply shortage are spreading throughout the industry, with the Saudi official cautioning U.S. short sellers to be watchful. Adding to the worsening situation, national gasoline inventories have dropped for 3 consecutive weeks, reaching their lowest levels for this time of year since 2014. Moreover, total U.S. fuel oil production is expected to decrease this month following a substantial decline last week, particularly in Gulf Coast and East Coast refineries. Data from the EIA shows a 15% decrease in fuel oil production by Gulf Coast refiners and a 9% decrease by East Coast refiners so far this month. Analysts predict that the current lower gasoline prices compared to a year ago may not last, warning of potential near-term doubling of prices that could strain consumers' finances. Inflated prices for essential goods further stretch budgets, negatively impacting the economic recovery and growth, as stated by the International Energy Agency, IEA, in its oil outlook. Summer gasoline, although more expensive to produce, emits fewer emissions, while cheaper winter gasoline is easier to ignite in cold temperatures. The warmer weather typically attracts more drivers, significantly boosting gasoline demand. Increased demand generally leads to higher gas prices. ADA spokespersons, St. Anthony and Finnegas, note that peak gasoline demand signals imminent price shocks for drivers, potentially exacerbating inflation beyond policymakers' expectations, Bloomberg News. When fuel inventories dwindle and prices skyrocket, people tend to hoard fuel, fearing that gas stations will run out completely. This was evident in 2021 when Americans witnessed long lines outside gas stations due to supply disruptions and increased costs. In 2023, a single extreme weather event left 7 states, including Virginia and North Carolina, without fuel, leading to a state of emergency declaration to prevent the crisis from escalating. CBS News reported that people waiting for gas expressed the fear of missing out and being left without fuel. More recently, the Miami-Fort Lauderdale area experienced widespread gasoline outages due to a historic storm and subsequent panic buying by drivers. Over half of the gas stations in the area were without gasoline, and even a station in Key West had no fuel to offer. The situation was described as scary by employees, facing delivery delays that took weeks to normalize. The surge in demand caused by drivers rushing to open gas stations intensified shortages and closures. Experts noted that this scenario is likely to repeat itself during the summer. Panic and the desire to maintain mobility drive people to fill up their tanks when they see gas lines or encounter closed pumps, as stated by industry analysts. This rush to buy gas and the resulting shortages become more pronounced once the public becomes aware of potential supply disruptions, as observed after the 2021 ransomware attack that shut down the Colonial Pipeline. Recently, researchers at Carnegie Mellon University warned of the risk of widespread outages in U.S. gas pipelines and urged officials to take preemptive measures before supplies reach critically low levels, as published in the Electricity Journal. Conversely, the diesel market is experiencing significant changes, indicating the unfolding of a severe economic slowdown. Ed Morse, Citigroup's global head of commodities research, highlighted that oil demand is being crippled by the anticipation of an economic slowdown and deep recession. Similarly, U.S. diesel demand has steadily declined this year due to a slowdown in freight and industrial activities, influenced by higher interest rates and decreased consumer demand for goods. Refiners are already observing a decline in diesel demand caused by persistent inflation. While transportation and logistics companies report the onset of a freight recession, numerous small trucking companies are facing bankruptcy. According to J.B. Hunt President Shelley Simpson, the freight environment is challenging, with deflationary price pressure amidst inflationary cost pressures, effectively constituting a freight recession. In the trucking industry, Chief Economist Bob Costello of the American Trucking Associations predicted that many small trucking companies will go out of business. Companies with fleets of 200 to 300 vehicles are failing at a rate of approximately one per week. Diesel futures, representing fuel delivered in the New York harbor, have plummeted to a 15-month low due to concerns of weak diesel demand stemming from a collapsing economy. However, U.S. distillate inventories have experienced a notable decrease in the past weeks, currently standing around 11% below the 5-year average for this time of year. Imports into the United States have also declined due to reduced freight activity as financially strained Americans cut back on spending. Shipping giant Maersk reported the lowest level of container imports in Los Angeles and Long Beach, the primary gateways for U.S.-Asia trade, since March 2020 when the pandemic and lockdowns began. Container imports at these ports dropped by 38% in February compared to the previous year, serving as an indicator of trucking activity for goods reaching consumers from the import point. The significant slowdown in the freight market is indicative of a crisis that is worse than anticipated. In the short term, Americans should expect more unpleasant surprises at the gas pump, while in the long term, preparations should be made for unprecedented outages and a downturn unlike any experienced before.